Understanding resistance in technical analysis. What is resistance? Resistance is a key concept in technical analysis that represents a price point or zone where an asset struggles to rise higher. It is characterized by a greater selling interest than buying interest at that level, ultimately hindering further upward movement. Resistance levels can manifest as specific price points, such as the high of the day, or as broader zones spanning several price levels. For traders, recognizing these resistance levels is crucial, as they can influence trading strategies and decisions. Types of resistance. 1. Single price resistance. This refers to a hard numerical value, such as a previous high, which has historically blocked upward movement in the price of the security. 2. Resistance zones. Unlike a fixed level, resistance zones may extend over a range of prices. For instance, if a stock price hovers between $50 and $55 during multiple upward movements, this area becomes a resistance zone due to repeated selling pressure within that range. Time frames and importance. Resistance can be identified across various time frames, short-term, like hourly or 30-minute charts, and long-term, daily or weekly charts. Generally, longer time frames suggest stronger, more significant resistance levels, making them more relevant for traders focusing on wider market trends. Key takeaways. Identification. A resistance level is defined by historical difficulties in price breaking above that point or zone. Multiplicity. The existence of several failed attempts to surpass a price point may create a resistance zone, increasing the likelihood of a price drop. Chart analysis. Trendlines and other mathematical tools help identify resistance levels, crucial for traders. How do supply and demand affect resistance? At its core, the principles of supply and demand significantly impact resistance levels. A rise in demand for an asset often leads to an increase in price as buyers aggressively absorb available supply. However, when selling pressure coincides with buying interest, it creates points of resistance. Factors influencing demand. 1. Economic indicators. Macroeconomic news, such as changes in interest rates or strong earnings reports, can shift demand, leading to upward price momentum. Conversely, poor earnings or economic downturns can lessen buying interest and establish a resistance point. 2. Market psychology. Traders often set predetermined sell points for profit-taking, which can exacerbate resistance when many decide to sell at similar levels. Supply dynamics. Supply at a resistance point can stem from profit-taking. Traders looking to capitalize on gains can sell their shares right before reaching a target resistance, reinforcing the barrier against upward movement. Defensive selling. Option holders may choose to sell shares at resistance to secure profits and minimize losses. Additionally, negative macroeconomic news can trigger increased short selling, establishing a strong resistance barrier. Trading using resistance. Once a resistance level has been identified, traders can implement various strategies based on their market outlook and positioning. Here are some common approaches. 1. Short selling. Traders anticipating a reversal can short sell as the price approaches a resistance level. They may aim to profit from a downturn if the resistance indeed holds. 2. Profit-taking. For long positions, traders may opt to sell shares as they approach a known resistance level, locking in profits before potential downward movement. 3. Breakout trading. Aggressive traders may place buy-stop orders just above a resistance level, anticipating a breakout. Once the price exceeds this level, momentum may attract further buyers and push prices higher. Psychological resistance levels. Traders often pay particular attention to larger, round numbers, like $100 or $200, as these represent crucial psychological barriers in market behavior. They can become self-fulfilling prophecies as many traders set orders around these levels. Identifying resistance levels. Technical analysis can help traders pinpoint resistance levels through various methods. Trend lines. Trend lines visually represent historical price action and help to forecast potential resistance. When prices repeatedly hit a trend line and pull back, it indicates strong resistance. The polarity principle states that once a resistance line is broken, it often becomes a support line. Technical indicators. Several technical tools can also identify resistance. Some popular ones include moving averages. Simple and exponential moving averages help smooth out price data and highlight trends. Bollinger Bands, a volatility indicator that sets bands around a simple moving average, can highlight potential resistance levels. Ichimoku Cloud, this indicator helps analyze price trends and identify support and resistance zones. Example usage. Using the case of NVIDIA Corporation (NVDA), traders could analyze its stock against Bollinger Bands to identify upper resistance points, guiding their trading decisions based on expected price movements. Conclusion. Resistances serve as crucial reference points for traders. Knowing how to identify and interpret these levels can significantly affect trading strategies. Whether traders decide to short sell approaching resistance, take profits on existing positions, or capitalize on breakouts, monitoring resistance zones is vital for successful trading outcomes. In the context of investing and trading, understanding resistance goes beyond simply recognizing price points. It involves analyzing market sentiment, broader economic signals, and employing technical strategies effectively. As part of a comprehensive trading approach, recognizing and leveraging resistance levels can provide valuable insights and trading opportunities.